sure he needs no introduction, but joining me is Mike Arougheti, the CEO of Ares and co-founder of Ares Management. Mike.
Hi, everybody.
Thank you so much for joining.
Thanks for having me.
So the title of the panel, which I actually don't think I told you before you arrived, so a nice surprise,
okay.
The next 1.5 trillion.
Perfect.
It is true, right? It's accurate. So let's talk about the next 1.5 trillion. What is it going to look like to get there, to 3 trillion? How fast will that happen, you think?
How fast will it happen?
Yeah.
Inside of 5 years.
Okay.
And that's just math. If you look at the indexed growth rate for private credit, without some of the things we should talk about driving the future growth, it's been roughly 10 to 15% annual growth rate.
Okay.
Right. So if you just compound that, that'll tell you that the market will double over the next 5 years. Maybe would it be helpful just take a quick step back and say, how did we get to the first 1.5 trillion? Because I've been in this business now 25, 30 years. No one ever wanted to talk about private credit. Now it's all anybody seems to want to talk about. I wouldn't say it's my time, but it's
yours and others.
And others.
Yes.
We share. It's not like this happened overnight. So there is this overarching narrative, I think, that's prevailing in the media and the investment world that there's this whole new asset class that has just emerged, out of nowhere to take the world by storm. And I think it's important to understand how this has happened, and that if you really go back and look at the development of the market, it's been keeping pace with a lot of structural changes that are happening in other markets. For example, if you look at the public equity markets, they've been consolidating, they've been moving to scale. The average market cap of a public company today versus 20 years ago is 500% of what it was. Banks have consolidated in a significant way in the U.S. There has been overarching regulation coming through the great financial crisis as well as the Basel frameworks. You've got the leveraged loan and high yield markets that are also moving to scale. So behind this what seems to be cataclysmic growth in private credit, you've had real structural changes happening in all of the adjacent markets that have set us up for this moment. Knowing that has created white space, then you have to say, well, what other structural changes are going to happen to get us to the next 1.5 trillion?
Sure.
Because the reality is, if all we do is finance the existing equity that's in the market, we'll get there. So maybe you should say, what is it going to take to get to the next 3 trillion? And when you look at what was that? I
was going to say.
Don't publish that as like a big out of context headline like you guys usually do. But
we would never do that.
The U.S. banking system has gone through a 2-3 decade period of consolidation. We are still massively overbanked. So we went from 8,000 FDIC insured banks to 4,000. I think the next largest developed economy in the world has maybe 100.
Right.
So we've had this slow move to consolidation. I think some of what we saw earlier in the year with Silicon Valley Bank and PacWest and others is going to accelerate kind of what I would call phase 2.
Right, because I've heard you say before that it's a 2-year process, this banking crisis. Yes. And I think that idea would surprise a lot of people because for so many of us, even though it was this year, we've kind of erased it from our memory.
Seems like 6 years ago.
It does. It really does feel like that. So if we're in the middle of a 2-year process, what does phase 2 look like? What does the end point look like?
So with regard to the banking challenges, the first thing, now that all of the liquidity stress, at least for the time being, is out of that market and people can be more measured and intentional about how to manage the balance sheet, it looks like first asset sales. And we've been participating, as have others, in some fairly substantial portfolio trades out of the banks. And what's interesting about the balance sheet management is you're going to try to sell your highest quality, highest priced assets first, because to get to the other side of the balance sheet and P&L challenge, you've got to minimize risk either on the P&L or the balance sheet. So the types of deals we're seeing are portfolio trades for higher quality performing. I think that's phase 1. That could also take the shape of what we would call a reg cap trade, which is folks like Ares bringing in junior capital or higher risk capital onto the bank's balance sheet in partnership with them to somehow change their risk positioning and get better reg cap treatment. But the big transformation, which is why I think we're saying maybe it's more than 1.5 trillion, is with the implementation of the new Basel framework, the cost of equity is going to go up dramatically for banks. knowing now that we don't have deposit security, the whole way that people think about managing the balance sheet has to change. There has to be a move to shorter duration. There has to be a move to floating rate. I think a lot of banks will re-underwrite their business between core, non-core, and a lot of those non-core assets and businesses will likely find their way into the private market. And when they do, you'll need a lot of institutional capital to backfill.
So if all of a sudden we're in this world where assets that once lived on bank balance sheets are now with you and your peers, does your responsibility change as sort of a steward for the global financial system?
Again, this goes back to I don't want to say that this private credit narrative is much ado about nothing, because it's a real thing and it's really exciting. But no, I mean, we obviously take our jobs as fiduciaries seriously. We tend to be a very long, creative, flexible capital partner to companies and asset owners, but also to the banks. So I think we're just going to play a larger, more complex role in this system.
Right.
But the one thing that you have to appreciate when there's all this discussion about non-banks and banks, private credit is an institutionally funded, for the most part, asset class with very large, sophisticated institutions with duration that want to invest into private assets with no leverage, right? So when you think about where does all the risk tend to come out in financial crises, it's usually asset liability mismatching. And I think making comparisons between the risks inherent in a 10 times levered bank balance sheet with flighty deposits, just a fundamentally different business. And then if you look at the asset side, the bulk of private credit assets are bilateral, negotiated, long-term negotiated relationships between a credit provider and an asset owner or a company owner. And so the way that you get through good times and bad times is fundamentally different. So I don't think it changes our fiduciary responsibility or our perspective. I actually think you're going to find that it's going to bring a fair amount of stability into the markets. And you're already seeing that now, right?
Yeah.
Some of the volatility that we're seeing is not bleeding over as much as it has in prior cycles, I think, because the private markets are coming in as a stabilizer.
It's interesting to hear you talk about working with banks. And you hear someone like JP Morgan's Jamie Dimon say that private capital is dancing in the streets because of new regulation coming in. I mean, it does feel like there is some tension, or is that us inventing this?
I think it's you inventing it. I'm a terrible dancer.
I'm humbled.
I'm a terrible dancer. Look, I think any time there is change, people are going to wonder, what does it mean for my business long term? And if I were the CEO of a large bank, I would be wondering, what does this mean for my business? But it's interesting because JP Morgan is such a wonderful global financial institution. We're obviously a very large client. We partner more than we compete. And last I checked, they've been growing pretty nicely through all of this, turmoil too. So it's not a zero-sum, we win, banks lose. It's really, everyone is kind of doing what they need to do together. So I think it's a provocative thing to say. Maybe I would have said it differently, which is when rates are high and capital markets are capital constrained and banks are in transition, it's a good time to be in the private lending market, right? But that's, I assure you, we're too busy to be dancing right now.
Fair enough. Although you got to make time for it every now and then, Mike.
Yeah.
It's one of the joys of life. Look, while we're talking about growth, let's get in kind of the nitty gritty of what type of products experience growth. This is something you and I have talked about. We hear Apollo, Blackstone, a lot of your competitors talking about excitement over asset-based and investment grade. This is something you've been doing for a while. How are you thinking about the growth of those types of products?
Yeah, I think the growth in asset-based, asset-backed, structured is real. And again, this trend has been growing since the GFC. And so if you think about what I said earlier about this consolidation and shift in the liquid credit markets, we're now seeing post-GFC similar things take hold in the securitization market. So if you go back to the GFC and after, bank balance sheets were taking less risk. So a lot of this business used to get done on prop desks. It's not anymore. As a result, the securitization apparatus, broadly speaking, probably lost $2 trillion of capital. GE Capital went out of business. CIT effectively went out of business. And you had this distribution or dispersion of a lot of this specialty finance back into the market. And what's happening now is it's kind of reaggregating in the private market. So it echoes a lot of what we saw in the corporate lending space, right? Which is for either regulatory or economic reasons, these assets and people left the system. Now they're reaggregating. But again, what's interesting about private markets can structure the cost of capital to meet the demand for the capital in the market. Most other financial institutions can't, right? If you're coming to your insurance question, if you're an insurance company, 90% of your assets, by definition, have to be investment grade and rated. And what that means is that you have to participate in a very, specific part of the environment. If you're running institutional money, you have the flexibility to bring, cash pay, PIK, senior, sub, long dated, short dated, and that creativity and flexibility is actually one of the biggest advantages that the private markets have. So I think what my peers are identifying is absolutely real.
Right.
We've been at this business for close to a dozen years and have really attacked it from the sub-investment grade piece of it, because that's it's more aligned to the institutional asset management business.
And to that point, because you've said before, when asked about downturns, private credit downturns, that in all prior cycles, private credit has done better than looking at public investment grade markets. If we're in a world where more private but investment grade deals are getting done, is there some degree of sacrificing return for size?
There is, but again, it's all about risk return, and even when you're talking about high-grade fixed income alternatives, they're being bought by the investment community for some premium to what they could get in the liquid market. What they're also doing is they're paying for allocation, because they could typically get more bonds in the private market than they can in the public market, and I think they're also paying for active management of the credit instrument, right? So if you're putting aside the affiliated insurance companies, if you're an insurance company and you see an opportunity to generate excess return relative to the liquid instrument in alternative credit, you want to be with someone who will actually own that and manage it on your behalf. Whereas if you're buying a bond, there's an agency risk to it, right? And there's also a risk that the folks in your syndicate are not aligned to whatever your view on the credit is. So, I think one of the reasons why private credit outperforms is because of that control, that element of bilateral relationships where everyone's aligned to maximize the value of the enterprise, and no one is coming in below par.
Okay.
So there's no difference of opinion between lenders as to what the right outcome is.
So that's a little bit about the product. What about regionally? Where do you see the biggest gap right now?
Well, I don't know if it's a gap, because again, the geographies are all growing at different rates with different opportunities. So when I look at the U.S., and we go back to what I said earlier, you had bank consolidation, growth in private equity and scaling of private equity, consolidation in public equity markets, development of the CLO apparatus, development. You kind of check all those boxes, and here we are with a huge private credit universe that lives alongside these markets. If you look at Europe, and again, Europe is not one market, each of the different geographies function slightly differently, but when we came here in 2006 to build what is now, I think, the leader in private credit here, we said, okay, we're beginning to see some of those same patterns emerge in terms of bank behavior, the development of the private equity asset class, so on and so forth. Asia, and again, Asia is not one place, but it is very far behind in terms of the institutionalization and maturity of those markets. So with that in mind, we're attacking each market differently, right? In the US and Europe, it's more performing credit, backing institutional owners of companies and assets, building deep origination engines in the local markets. The farther we move towards APAC, it tends to feel a lot more opportunistic, special sits, because a lot of those economies and capital markets are still developing.
Right.
In a way that the risks that you're taking require a different set of skills and a different set of return in order to take those types of risks.
Well, what does it mean to also have, the world's second biggest economy, China, the largest economy in Asia, to not just be facing economic problems, but also geopolitical risk there too? How does that change the risk profile of investing?
Well, it used to, they said, if China got a cold, then the entire region got the flu, or whatever that. And I think that is true. So one of the challenges, I think a lot of folks expected the Asian economies to accelerate out of COVID first,
right,
because they were early and kind of got over it. But lo and behold, here we are. And I think the struggles that are coming out of China are real and have left some people scratching their heads. Over time, I think that the rest of the region will be a very big beneficiary. So the whole China plus one phenomenon is real. We're seeing capital already move to Southeast Asia and India to make sure that there's a diversification of supply chain and exposure to China. So right now, it's making it a very difficult market to invest in. There's obviously a lot of volatility in the bond market. Very difficult to invest in the mainland right now.
Do you wait that out, or are you still finding opportunities?
We are not actively investing in China right now.
Right.
I think over time we will, if we're allowed to in a meaningful way. But it is actually accelerating opportunities in other places in developed and developing Asia, and that's actually been something that we've been focused on.
So I want to get some more numbers out of you, just in the ethos of this title. Last month there was a new record for the largest loan. I got to look at my notes because I would mess this up if otherwise. So it was Oak Hill, Blue Owl, and HPS. $5.3 billion loan package to Finastra. $5.3 billion. Do you see that size being trumped soon, and trumped in a large way?
When you say Trump, do you mean in the
Bigger.
card-playing kind of thing, not in the presidential way? Because it would
Correct. That's a whole other can
Yes.
of worms. We need a different panel for that, Mike.
like manipulated and
Mike.
Okay, so I would say the following. First of all, that was a much broader club, so we were a
Sure.
meaningful player in that deal as well.
Sure.
I absolutely think you'll see deals that are larger than $5 billion.
How much larger?
I mean, if I look at capacity in the market, I think right now, based on the capital available, you could easily put together a club deal for $8 to $10 billion in the private market, no problem. The question is going to be how many of those deals actually exist, and when they do, what is the the puts and takes of an execution in the private market versus the liquid market. So
Right.
I think the capacity question has been solved for. Now it's a question of whether or not the borrowers will see value to execute in the private market.
I mean, there is this argument out there that, deals of this size and just, the most recent growth of private credit is a cyclical phenomenon. I was talking to Steve Schwartzman earlier this week, and he said, look, a lot of what's happening is cyclical. Rates go down, you'll see real estate come back up. How much of private credit growth, I know you're talking a lot about structural changes, but how much of the current growth is just cyclical, and once we leave a high rate regime, it will ebb?
I think the bulk of it is secular. Back to my earlier comment, I think that there have been structural changes in the liquid markets that are forcing people into the private markets, and they're staying there longer. And I would expect that to continue, again, because of what's happening in the banking market and others. The cyclical piece is kind of what you're talking about with the Finastras of the world.
Sure, yeah.
Right? So if you look at just some numbers, like if you look at the high yield market and the leveraged loan market, 30 years ago, 40% of those markets were to borrowers with $300 million or less issue size. So just think about that market. What it was a middle market, liquid market. Today, it's probably 1% to 3% in each of those markets, which means that those markets are no longer delivering effective and efficient execution for larger borrowers. So guess what? They come to the private market for that execution. But when the banks are de-risking and the CLO market is not, forming capital, the available market at what I would call the upper end of the private market and the lower end of the liquid market converge, and there's market share to be taken. That is cyclical. But you'll see over time it kind of step function grows as we're able to service larger and larger borrowers. So, I don't think that will stop, but it definitely, ebbs and flows. So last quarter, 85% of buyout financing was done in the private market.
Right.
That's not a sustainable number.
Yeah. Okay, fair. Can I ground this in Ares itself too? I know a target you've given out before, 2025, $500 billion. You're here amongst all of your closest friends. Do you want to give a new target? Is that still what you're aiming for?
We can't give a new target because we're a publicly traded company. But we're well on our way.
Yeah.
And we have affirmed and reaffirmed that target. And again, if you do the math on where we are in the growth rate, everyone can kind of extrapolate where we could go if we can continue to perform the way that we perform.
Right. Mike, we're also in this world right now where a lot of men and women investing right now are seeing 5.5% rates for the first time. You've seen them before. You've invested through them. What would your advice be to young folks right now about risk in this higher rate environment?
Well, as professional investors or personal wealth creation, because I think sometimes they don't actually.
Actually, I'm interested to hear both of them.
Well, I mean, I've been a big believer. It's very funny. It's one of the reasons why I think we were early to private credit. The value of consistent compounding yield has always been underappreciated. And one of the reasons why private credit is growing, we're generating 8 to 10% yields plus consistently with very low loss rates. So again, if you do the math, you don't even need to grow the number of borrowers in that market to see this market doubling every 4 or 5 years. So I think the value of compounding yield is a very, very powerful thing. And I think we all get intellectually, drawn into equity and growth and trying to pick the next, hot thing. But if you could chip away at 8% for 20 years, you're probably going to outperform, most, if not all, investable asset classes, which I think is why private credit is having a moment now, because I think it's really, highlighted for people the risk-reward disconnect sometimes, and it happens more often than people would admit between equity and credit. So that would be my first piece of advice: is don't ignore the value of durable yield over time. And two, which is again, this is just math. Interest rates correlate to asset prices.
Right.
So it's not shocking that all of a sudden we have equity values that are getting challenged in the private markets and capital is transitioning all over the globe. So the only advice is don't lose sight of the impact of cost of capital and availability of credit on the equity business and the cost of equity. Right? I think a lot of times people disconnect those things, and as the markets continue to get more globally connected and more levered, whether it's the government balance sheets or corporate, you have to really have a keen understanding of credit and debt cost of capital if you really want to be a good equity investor.
Right. So correct me if I'm wrong, but you do expect that we can avoid a recession?
I do.
Yeah.
I continue to believe that we can. It's going to be there's so many countervailing things happening here, but everything that we see in our portfolio, and I think it was shared on the prior panel, particularly in the U.S. economy, that there's real fundamental strength. The consumer is weakening, but generally hanging on. Labor market is tight. And at the end of the day, we've now kind of front-loaded the curve where if we need to start cutting, we can.
Right.
And I would not underestimate the opportunity to do that. I'm not saying that that's what's going to happen, but we now have the tools in place from a monetary policy standpoint to do what needs to get done if we need to go in the other direction.
Well,
so
part of the reason I asked that, though, is because you mentioned, leveraging up of also government balance sheets. How often are you thinking about a potential fiscal accident?
I actually worry about that now more than a monetary policy accident. But one thing that we talk a lot about is if you take the Fed's balance sheet, for example, and you look at what the Fed holds relative to what it used to hold, one of the things that we think a lot about is like, okay, if rates backed up the way that they just did in a prior market where the government balance sheet wasn't willing to support those markets, there would be some individual investor or some pension fund or some insurance company on the other side of that pain trade.
Right.
And that would reverberate through the markets in a way that it's not happening now. And the reason it's not happening is the government has effectively socialized a lot of those losses onto the government balance sheet. You saw it here in the UK too with the gilt crisis. So the interplay now between central bank balance sheets and the liquid markets is new. It doesn't mean that there's not real risk that's being introduced into the system given the amount of leverage there, but one of the things that I spend a lot of time thinking about is the markets are not expressing the volatility that we all would expect given how quickly rates have risen. Right. And I think a lot of it has to do with the way that the banks are interacting and intervening in the market.
Right, and the fiscal stimulus and that sort of thing as well.
Yeah, and I think the big risk now, in the global context is obviously, what happens with deficit spending, what happens with, social and cultural issues that need to get funded. And so there's a fine balance here. So I think there's a bigger risk that we make a mistake there now, because for the most part, the monetary piece is kind of done, right? We kind of know what we have there. So I think most of the uncertainty is probably on the fiscal side.
Yeah. I feel bad because we're just out of time, and that was quite a negative note, but you're not expecting a recession, so we can end it there.
Yes, perfect.
Wonderful. Everyone, please join me in thanking Michael Arougheti.